All right, excellent. Well, welcome everybody. Thank you for tuning in again. It's been only about a month, I think, since our last all-client Zoom, and there wasn't really any particular event that spurred me to schedule this meeting, other than that what I was talking about last January with the big drop that we had in the market has simply continued. Hasn't dropped a whole lot more, but it's kind of been a consistent down market for the first almost full 2 months of this year. We've seen, the stock market drop about 10%, which technically fits the definition of a correction. We've also seen bond prices drop here in the first, really just January. They've remained pretty steady so far in February, but we saw bond prices drop quite a bit in January, simply in anticipation of the rate hikes that we're expecting through the rest of the year. So we're at a place that's kind of an uncomfortable place from a portfolio standpoint, where our two main assets, our two main investment types, stocks and bonds, have both dropped. Okay, and so what I wanted to share with you today is kind of the plan for the portfolio as it is right now, remind you of kind of what we implemented last year, and then kind of talk about whether this just is a correction that we quickly bounce back from, or whether this is the beginning of the next recession, what the plan is. Okay, I'll go ahead and transition into my presentation now. Excellent. Okay, so whether this period of time ends up just being, like I said, a quick 10% correction, or whether it becomes the beginning of a next recession, I want you to understand what how the portfolio is to be managed in either of those two cases. Now, this is a slide that I shared with you in our presentation last month, which covered, since the Great Recession in 2008, when we saw the market drop about 50%, okay, until most recently, where we saw the market drop about 9%, what are some of the big drops we've seen along the way, or similar drops we've seen along the way? And what I told you in our last call was that, pretty regularly, about every 1 year to 2 years, we see this correction in the market. And I've highlighted several of those, not even all of them, but several of them between the Great Recession, through the COVID crash, all the way to today. And so when it comes to these corrections, there's really only one plan, and that is to do nothing. And oftentimes doing nothing is the best thing you can do, because these corrections, sometimes they last a few weeks, sometimes they last a few months, but they're simply a blip on the way to a continually growing economy, continually growing corporate profits, and thus continually growing stock prices. So if it is just a blip, the best thing we can do is nothing. But we have to be prepared, because we never know when one of these little blips turns into the next recession, turns into something like the Great Recession or the COVID crash, all right? And so what we have to be prepared for is, how are we going to manage the portfolio if it takes 5 years, like it did during the Great Recession, for the stock market to reach new highs, okay? Or it could be like the COVID recession, where it only took 6 months for the stock market to recover. We don't know how much time it's going to take, so we better be prepared for anything between 6 months to 5 years. On average, if we go back much further in time, all the way back to the 30s and 40s, right, the Great Depression, and we look at recessions that we've gone through along the way, on average, we're talking about typically covering about a 2-year period for the stock market to recover from a recessionary drop. Okay, but what is the plan in case it does take even 5 years? All right, there's a ton of information on this slide, and I recognize that it is overwhelming, okay? And I'm not even going to try to go over all the details on this slide. But what you're looking at is, you're looking at a year by year view of what the best and worst types of investments were in each particular year. Okay, so if I bring your attention all the way to the top left, you'll see under 2002, the very top light green box says global ex-US fixed. Okay, that means that in the year 2002, the best performing investment was international bonds, okay, returning about 22%. If you go all the way to the bottom of that column, you can see the worst performing investments of 2002 were in dark blue, large cap equity. That means large US stocks, okay? And then that pattern is continued every single year, showing you the best investment at the top, the worst investment at the bottom, okay? So for instance, the worst investments in 2003 and 2004 were cash, okay? What I want to bring your attention to is 2008 through 2012 as an illustration, and I'm going to use this data to illustrate for you what our plan would be to ride out a possible 5-year recession in your portfolio, okay, by focusing on the investments in each year that are the best performing investments and which investments in each year are the worst performing investments, because that's the key to diversification. So in our next slide, I'm going to cut out what's in that red box, which is just a view of the best performing investments between 2008 and 2012. Okay, so if I cut that out and I zoom in, this is what we're looking at. Okay, now I have two types of clients on the call today. Okay, I have my retirees and my pre-retirees. And then I have my accumulators, okay, those who are still in their generally 30s, 40s, maybe even early 50s, who still have a ways to go, who are still saving up for retirement, okay? And then there's my retirees and my pre-retirees that are really focused on how do I begin to manage my portfolio to create cash flow, okay? This slide is directed at my retirees and my pre-retirees. There is one simple rule we need to focus on, and that is don't sell low. All right. Right now, we've had about, like I said, a 10% drop in the stock market. Most of my retirees, your portfolios are down maybe 4 to 4.5% year to date. Okay. Again, we're not worried if it's just that, if it's just a blip. What we're worried about is if this turns into the next recession, how are we going to manage through it? Okay. Well, most of my retirees, you guys are taking out between maybe 4% to maybe as much as 6% out of your portfolio every year as an income stream. Okay. That's the most typical thing, which means if we're planning for a recession to possibly last as much as 5 years, we need to find 30% somewhere in your portfolio that we can use to generate cash flow for you without selling any stocks, without selling low, because we're assuming it's going to take that long for the stocks to recover. So if we looked at 2008 and said, okay, what if we experienced something similar to 2008? Well, we can see even in a horrible year like 2008 and 2009, there were lots of investments that were actually up, and some of them were up considerably, okay? In 2008 alone, US fixed income, okay, which for many of you is about 25 to 30% of your portfolio, was up 5.25%. Global fixed income, international fixed income, bonds issued by other countries, of which all of you guys have an allocation to, up 4%. Even cash equivalents were up 2%, but everything else was down. But the point was, for that 1 year, we had more than enough investments to tap to create the income we needed to not sell low. 2009, again, we had asset classes in the portfolio that we could tap to create the income you need so that we could avoid selling low. We had emerging markets, we had high yield bonds, even real estate had already started coming back. This was the commercial real estate, right? 2010, small cap equities had begun to rally. Now they'd had 2 really bad years, so we probably wouldn't have sold those yet. But real estate was again coming back. Emerging markets had a good year. High yield had a good year. And even large cap equities were finally up a little bit by 2010. So again, we had things up in your portfolio that we could sell high, okay, and avoid selling other things low to continue generating the income. All right. And we would do that every year until the stocks had begun to perform well, and then we could begin to use that to generate the income. Okay, so that is the plan should this correction turn into a recession. Now, for all of my accumulators out there, it's really simple. Buy the dip. Okay, this is an excellent time to be investing cash into the portfolio because stocks are down, bonds are down, real estate's even down a little bit, believe it or not. Okay, commodities are the only thing in their portfolio that's up right now. So everything is cheaper today than it was in December. Okay, and so I am urging a lot of my clients who are either sitting on cash or who are regularly saving into their portfolio, don't be scared off by this. This is the opportunity to jump and buy in low because you have the time to ride out whatever ups and downs the markets are going to give you. And certainly these dips are just wonderful, cheap times to buy investments low. Okay. And always remember, of all the factors that go into your long-term returns for your portfolio, the number one factor is the amount of time you've stayed invested in the market. Number one factor. So never try to jump in and out, stay invested, use time value of money to your advantage. Okay, let me remind you guys a little bit about what some of the returns on our portfolios have been. They are very similar to the returns that I gave you last month because the market just really hasn't moved much. It's gone up a little bit, it's gone down a little bit, but overall returns have pretty much stayed where they are, okay? If you are about 5 years away from retirement, okay, you're probably in my growth portfolio with a target return of about 8 to 9%. Year to date, my clients in the growth portfolio are down about 5%, but that's after some astonishing years of 22% in 2019, 9% in 2020, and 14% in 2021. Again, important disclosure, your individual returns will absolutely vary because this does not account for money flowing in and money flowing out and individual transactions done in your account. But this is an average across our portfolios. If you are just pre-retirement or in early retirement, you're probably in my growth and income portfolio with a target return of about 7 to 8%. You're down about 4.5% as year to date, as are my late retirement clients who are in my most conservative portfolio, my income portfolio, also down about 4.5%. But again, those drops so far this year are following much higher than normal returns the last 3 years, allowing it to kind of average out. And that's the way the market goes. The market never returns the target return year in and year out. It delivers higher than normal returns some years and much lower than normal returns other years. Okay. So what does my crystal ball say? Okay. I know you guys all want to know what I think the rest of this year is going to deliver. Okay, well, here's my thoughts, here's my predictions. Okay, this is not the beginning of a new recession. I really believe that this is a correction. I think it's a healthy correction, and I do not believe the economy is about to dip into recession. What I do expect is much more moderate returns from the portfolio. I'm predicting mid-single-digit returns for all 3 of our major portfolio types for both this year and next year. I think it's going to be mild return years, 3%, 4%, maybe 5%. I am not predicting double-digit returns this year or next year. And I also don't think we're going to end up with negative returns through the end of this year. Okay. We all know that there is an extreme labor and supply chain disruption going on right now. But the good news is there has been relatively low government interference in the labor and the supply disruption. You know, there's no trade wars going on. You know, the trade war with China has dampened down quite a bit. There's no rationing, forced rationing going on. There's no price fixing going on. Okay. All of those would be disastrous policies that would simply exacerbate the labor and supply disruption. All we want is to let the market work it out, okay? And we want people to get back to work, and we want supply chains to work themselves out, okay? With as little government interference as possible, because that'll be the most efficient route to a working economy. Also, inflation. I know it's annoying. I experience it also. I'm seeing gas prices in the $5 and higher. Okay, I'm feeling it also. But it really is, from an economic standpoint and for your financial security, it's really just annoying. Okay, it's really not dangerous to any of my clients. All right. You know, and again, inflation is not going to be a big problem for you as long as we see continued low government interference, so no price fixing going on, okay? Also, this is kind of the new variable, no extreme cyber war with Russia. You know, I think in one of our previous calls, I had been asked, you know, what a war with Russia over Ukraine would mean to your portfolios. And I said, I really didn't think it was going to be a big deal unless there was some infrastructure destroying type of warfare. And it hadn't really occurred to me that a cyber war, it can be an infrastructure destroying type of war. The problem is we have absolutely nothing to compare it to. And I simply don't know what the consequences of that might be. But I would not panic over that. Okay. And then, of course, hanging out there is still the Chinese debt crisis, which we don't have an answer to. It's simply China's a black box. So we don't know whether things are better or things are worse, but there is concern that China is over levered. And if instability in the world ends up affecting China's economy to a greater deal, that debt crisis might actually come to light and become more of a global problem. So those are the things I'm watching out for to that could possibly drive us from a blip into a recession. But I don't think those are likely to happen. The good news is, if it does happen, we have a plan in place. We know how to manage your portfolio through that type of period to continue to keep you guys financially secure. Okay, that is the end of my prepared remarks. I'm going to stop sharing my screen, bring us back here, and I will open it up to any questions anybody might have. Any questions? Greg, yeah, go ahead and unmute yourself. Greg Cham.
Hey, John. So the Fed signaled that it might or would be raising rates in March. How does that affect mortgages? What type of jump do you think rates will take, and how soon?
Sure. So the Fed has made it pretty clear they're going to raise rates 6 times through the end of this year. Now, what they're actually raising is short-term interest rates, okay, which has no direct effect on mortgages. But the consequence of it is that they're also pulling back on their quantitative easing, okay, which was them over the last 10 years going into the longer-term bond market, okay, and buying up those mortgages to drive down longer-term interest rates, okay. The best thing the Fed can do for a long-term healthy economy is get out of the long-term interest rate game. We don't want them messing around in the long-term interest rate game, okay? But it is going to be a little bit painful for all of us in the short run, as both short-term interest rates go up immediately and longer-term interest rates go up less immediately. I mean, typically it's usually like a 4 to 5 month delay kind of thing, but these are different times. It's harder for that rule of thumb to actually hold true. So we'll see, we'll see as the Fed stops controlling long-term interest rates, the market takes over, right? And so we really haven't had a true market-driven view of what long-term interest rates should be. And so as the Fed begins to pull out, the market will be able to bid up interest rates as they see fit. So they could end up skyrocketing. They could end up not going up at all. That's where that interest rate volatility comes in. That made me a little bit nervous. And that was why, for my retirees and my pre-retirees, we pulled out a large chunk of your bonds and moved them into the structured notes. for exactly that kind of uncertainty with the longer term interest rates. So that's my best
Thanks,
answer there. I know it's only a
Okay.
half answer, but that's my best answer. Other questions?
Yeah, John, I have a question. The returns you were talking about, they were not real returns, right? They don't include inflation, right?
Correct. They do not include inflation. When I quote the target returns on the portfolio, okay, like 7 to 8%, right? Those are assuming normal inflation environment, okay, somewhere like a 3% inflation rate. The actual target return for all of your portfolios is actually a return above inflation, okay? In order for the retirement projections that we've done for all of you, in order for those to be valid and us to be confident in the conclusions that we derive from that analysis, okay, your portfolios have to be beating inflation by somewhere between 3% and 5%, okay, depending on your phase of life, okay? Which means whatever inflation is, if it's 1%, if it's 10%, your portfolios need to be beating inflation by 3 to 5% on average, okay? So what does that mean for an environment where we have 7% inflation for 1 year or 2 years, okay? If it's 7% for just 1 year or 2 year, no effect whatsoever. Why? Because the returns the last 5 years have been killing inflation, right? The last 5 years, we've had double-digit returns and we've had low single-digit inflation. So we've built up this huge buffer of return above inflation, okay? So if we go through a 2-year period of relatively high inflation, no big deal. Now, if we go through a 4, 5, 6-year period of high single-digit inflation, now it's going to start to erode your real return. To your point, Steve, it's going to erode your real return, and it could cause us to have to redo those projections and no longer be as confident in the conclusions of those projections. But for right now, I am not worried, no concern. This is a 7% inflation for a quarter, 2 quarters, 4 quarters, even 8 quarters. It's just not that big of a deal. We've back tested your portfolios and your retirement projections through the Carter years, right, where we had double-digit inflation, and have been successful, right? And so that's why I'm just not worried about short-term, types of things like this. But we have to see. Hopefully we don't go through a 5-year period of high single-digit inflation. That would be a bummer.
Thanks.
Yeah, a bummer's probably not a strong enough word. Other questions?
John, I have a question.
Yeah, John.
Hi. So this whole Russia thing is obviously a big unknown, but Russia and China seem to be in cahoots. And China holds a lot of our debt, right? So, for Putin to kind of put the screws to us, could he have China call our debt? How would that affect us? Or is that just way too wacky of a worry?
Sure. So great question. What you're referring to is China holds billions and billions, maybe even trillions, I don't know the number, worth of treasury bonds, okay? So debt issued by the United States government. Now, the good news is nobody gets to call your debt, okay? It's not like China can say, hey, we want all our money back, pay us treasury. What they can do is they can sell those bonds, okay? Which means, they put them up for sale in the market. It dramatically drives down prices, dramatically increases interest rates. The problem with that is it would actually hurt China a whole lot more than it would hurt the US, okay? Because what it would do is it would destroy the value of the Chinese currency, okay? As they exchange dollars, okay, for the Chinese currency, it's gonna dramatically increase the price of the Chinese currency, right? Because they're gonna be getting rid of their dollars and exchanging it for more Chinese currency. That makes the Chinese currency much more valuable, which destroys them as the supplier of the world, right? Of the goods supplier of the world. That China has artificially kept its currency low for decades because it makes them much more competitive. Okay. So if they unloaded all those US dollars, it would really destroy their economy. And especially if they're as over leveraged as we think they are, it's almost like mutual assured destruction. I don't see how it's in their best interest to do that. But they could. The worst thing that can happen is that it drives down the value of US dollars, which, you know, how bad of a thing is that anyway? You know, there doesn't seem to be a lack of appetite around the world for our debt. Okay. And in a previous presentation, I tried to reassure everybody that the levels of our debt are not that big of a deal. They really aren't compared to the size of our economy. Okay. And so, you know, yeah, the problem would be if they unloaded it and there wasn't enough of an appetite around the world to absorb that much debt. It's potentially a problem, but I just, you know, I don't think they would do that. I think the Chinese are enough, they have enough of a long view where I just don't think they would have the appetite for doing that.
Thanks.
Yeah. Other questions? Okay, well, great. I hope this has been useful and helpful. If you do have any questions that you want to address one-on-one, don't hesitate to reach out. I love scheduling times for even just a quick check-in call. Just like, hey, John, gosh, I just need you to tell me again not to worry. That's okay. I field those calls all the time, and it's a big part of my responsibility because you know, when we create a plan together and we talk about how we're going to execute that plan, right? Getting you all the way along to the end is a big part of the value add. I am going to be sending out a recording of this video to everybody. If you know of somebody that would benefit from this information, that is maybe a little panicked right now, is not sure what to do if things get worse, you know, they might benefit from this information. So thank you so much. I will continue to schedule these all client Zooms. I hope this has been valuable and informative, and I hope this format continues to work well for you. So thank you so much, everybody. We'll see you
Thank
next
you,
time.
John.
John.
Thank
Take
you,
care.
John.
Bye-bye.
Bye-bye,
Bye.
John.
John.